Now, I have done many videos on this topic, and every time I do, it seems to be a hit. People seem to ask for more information. As maybe shocking as it is, there still isn't enough public awareness around the conversation between mortgage insurance and term life insurance, or the alternative, better alternative to insuring your mortgage. And to start off, let's just begin with there is no such thing as mortgage insurance. It is creditor insurance, labeled or marketed as mortgage insurance. So, mortgage insurance doesn't exist. You're simply buying a type of insurance for the creditor, which is the bank or the financial institution lending you the money to buy your home. So we got to stop calling it mortgage insurance. We got to start calling it creditor insurance. Now, the first thing with creditor insurance to be aware of is the fact that your family is not the beneficiary. The bank or the financial institution is the beneficiary, hence why it's called creditor insurance. So you're paying for insurance to insure the bank instead of insuring your family. Now, I'm not sure if you're aware of that, but you're certainly not buying mortgage insurance for the benefit of your family. You are insuring the lender who loaned you the money to buy the house. So that's the first point. Your family is not the beneficiary. The second point is whatever you're paying per month for this creditor insurance. Let's say your mortgage is $1 million and you're paying $100 a month just for simple math. You're going to be always paying $100 a month no matter what the balance of that mortgage decreases to. So if it starts at $1 million and literally the very next month that you pay off a little bit and a little bit and it starts chipping away and going down to 900,000, 800,000, 7, 6, 500,000, you're still paying that $100 a month. That doesn't decrease with the decreasing mortgage. So it's a little counterintuitive. You would think at minimum the cost of the insurance would reflect kind of the outstanding debt, but it doesn't. So your premiums do not change or decrease regardless of the fact that your mortgage is going down. And the third point I want to make is underwriting is done at time of claim, not at time of application or approval. And what that means is, and this is a very serious point, if you were to pass away, that is the time where they would underwrite your health history and go through an extensive health history to see if you forgot to tell them that you had cancer or you had a heart attack or something severe that maybe they wouldn't have approved you for, and they can actually not cover the claim. And if you Google it, there's a lot of articles around this and scenarios that have unfortunately happened to families thinking they had the coverage, but when one of the parents passed away, it turns out that they were denied the claim. So it's a very scary thing to think you might have this coverage, might pay for the next 10, 20 years, and then something happens and you're not even covered in the first place. And the fourth point I want to make is something called portability. And portability really means that if you get creditor insurance, it is attached to that mortgage and essentially to that home. If you were to sell the home or move or change banks or something like that, there's a good chance you're going to lose that insurance and have to get new creditor insurance. And that means you're going to be older. It's going to cost you more. This insurance isn't portable with you as you move or change banks or anything like that. So, I mean, those are four kind of quick points. They're massive points. I could talk on this all day, but those are pretty much the four biggest points I'd like to highlight in this video at least, which is the fact that the lending institution or the bank is the beneficiary. It is not your family being the beneficiary. You are paying for a level premium, even though the coverage is decreasing literally every single month. The fact that underwriting is done at the time of claim and not at a time of approval. And lastly, the portability. This is going to be challenging to bring with you as you move on through your life. So the question is, what's the alternative? Well, I wouldn't even call it the alternative. I would call it what's the right thing to do. And the right thing to do is to buy a term life insurance policy. So first and foremost, with a term life insurance policy, your family is the beneficiary. It is not the bank. It is not the financial institution. It is your family who will benefit financially, or at least will be covered financially if something were to happen to you. So that's kind of a good starting point, is the fact that you're truly insuring your family with term life insurance. Now, the second point is, With the premiums of term life insurance, yes, they do remain the same, but the coverage amount also remains the same. So if you had that mortgage, $1 million mortgage, and you get a $1 million, let's say a term 20, $1 million term life insurance policy. So you're insured for $1 million every single year for 20 years. Your premiums don't change every single year for 20 years, but the balance of your mortgage is still being paid off as it would have been if you had creditor insurance. So your mortgage starts at $1 million, then it goes down to 900, 800, 700, all the way down to zero. But your coverage is still for that million. So you're now creating a very healthy gap between the balance outstanding and what the payout's going to be. So if you were to pass away when the mortgage is $500,000, but you still have that term 20 for $1 million, well, $1 million is paid tax-free to your family. They could pay off the mortgage $500,000 and still pocket another $500,000. The funny thing is, if a parent were to pass away, it doesn't always make sense to rush and pay off the entire mortgage. There's a lot of circumstances and variables that would affect whether that's even the right thing to do. So having a lump sum payout in cash, tax-free, is a massive benefit to term life insurance, because the family can now sit down with their life insurance advisor, with their financial advisor, their accountant, etc., and go through what is the best use of this money. So term life insurance will definitely solve that. The third point is the fact that underwriting is done at time of approval. So if you go to buy term life insurance, depending on the amount, you might be able to get it without having to do medicals or anything like that, blood work, etc. But you're going to answer a lot of health questions to make sure that they will approve you. And if you get approved, it's black and white, assuming you didn't lie on the application, but you're approved at the moment of application, which means you have this coverage for the next 20 years if it's a term 20 or something like that. You don't have to be concerned that if something happens in the future, they're going to look back and catch something and maybe deny you. Now, if you have to do medicals, it's not really a big deal. You would do blood work, etc., and based on the results, they would hopefully approve you. Nonetheless, you're getting approved at moment of application, which means you're can kind of sleep well knowing you have this coverage. And the fourth point is the portability. This term life insurance you own. You are the life insured, you are the payer, you or your family's the beneficiary. It doesn't matter if you move or change banks, you're always going to have this insurance on you. No one can take it away from you. So those are pretty much the 4 points of the right way to insure your mortgage. It is term life insurance. Number one, it is the fact that your family's a beneficiary. Number two, it is the fact that your coverage stays level with your premiums. It's not decreasing coverage. Number three, your underwriting is done at time of application, which is a massive point and highly overlooked when comparing creditor insurance to term life insurance. And lastly, portability. The term life insurance goes with you pretty much wherever you go. So if you have creditor insurance on your current mortgage, if you have multiple properties, please look into if you took this creditor insurance. Sometimes people have it and don't even realize it. But if you did, I would really encourage you to look at getting term life insurance instead. It's a far better product and much better for you and your family. Thanks for watching.